So yes, Westshore Terminals. This actually came in from a client, Doug, and he says, "What are your thoughts on Westshore Terminals? BC's Warren Buffett owns a lot. They've been onshoring, and future commodities all flow through the Western ports." He says that labor issues are a potential issue, and he says, "This is for you, Brennan, just to show how valued your clients think of you." So I don't know if you actually think of me highly, or you're just saying that to get me to cover your stock. Either way, Doug, good one. You're getting me to cover it, so I love it. Um, so Westshore Terminals Investment Corporation, they're currently trading at a price of about $30.24, a market cap of about 1.9 billion, and a forward dividend yield of about 4.6%. So the company operates a coal storage and loading terminal at Roberts Bank, British Columbia, which is the largest coal loading facility on the west coast of the Americas. And revenue is derived from rates charged for loading coal onto seagoing vessels. And the coal is delivered to the terminal in trains and then unloaded and transferred onto a ship and shipped to multiple countries across the world, with the majority heading to Japan, Korea, and China. So, a few company updates here. Now, Westshore has commenced significant capital additions to the terminal to allow it to handle potash for BHP's Jansen potash mine in Saskatchewan. My cousin actually works at the Jansen potash mine. So, Westshore's management has indicated that the potash project is progressing well and continues to be on schedule and on budget. Now, the construction phase will take approximately 4 years, and Westshore expects to start handling potash in 2026, with phase one providing enough capacity for 4.5 million tons of potash shipped through the terminal annually. However, this is expected to reduce the capacity of its coal shipments, and there are additional phases, but there's been no timeline provided of when these phases would start to commence. Of course, they're focusing on phase one, and they're only going to be handling potash in 2026. Now, number two, in September of 2022, Westshore received a 72-hour strike notice from local 502 International Longshore and Warehouse Union, or ILWU, and the company made a tentative agreement with 502, and work continued, but labor negotiations with ILWU locals 514 and 517 are currently underway, with management stating in their MD&A that the potential talks will conclude successfully as early as the end of Q2 of this year, but we will see if that actually happens. And just a side note here too, what I believe Doug is referring to by the Warren Buffett of BC buying shares is that Jim Pattison's Great Pacific Capital has been buying in the open market at a price of around $31, with the company now owning about 17.4 million shares of Westshore's 62 million shares outstanding, which I believe is about 28%. Now, looking at the financials, for Q1 of 2023, revenue came in at 96.7 million, an increase of 9.5%, driven by an increase in tonnage to 6.9 million tons of coal. Earnings per share was up 29% to 53 cents per share, driven again primarily by an increase in revenue and that tonnage. The balance sheet has about 139.4 million in cash with no debt. But if we do include its leases, it has a net debt and lease position of approximately 140 million. And right now, the stock is trading with a PE of about 26 times. But this is due to the strike at the end of last year, which brought revenue and EPS down substantially. So if we look at more normalized times, I would say the valuation is closer to about 17 times earnings. And just to put this into perspective, the stock has a median PE ratio, a 5-year median PE ratio of about 12.5 times. So it continues to trade above its historical valuation. And management did provide 2023 throughput guidance volumes, which are expected to be approximately 26.5 million tons, which is an increase of about 13.7% from 23.3 million in 2022, with an average loading charge of approximately $13 per ton for this year, compared to about $12 per ton for 2022. I guess I'll just quickly show here too, where you can see Q3 and Q4 were impacted again by the strike. So I did just want to quickly show the volatility in annual revenue and EPS over time. So as you can see here, there really hasn't been consistent growth. And to go to my conclusion, long-term revenue and EPS have been volatile, with a revenue compound annual growth rate of negative 0.2% from 2013 to 2022. Now, the stock does have an attractive yield of 4.6% and a 12 trailing month payout ratio of about 110%. However, it's closer to about 76% if we normalized their earnings without the labor strike. And the company has also paid some large special dividends in the past of about $1.50 per share. And the last one that they paid was in March of 2022. Now, the company is diversifying operations to include potash by 2026, which is a positive, of course. We're moving away from the coal. They've got a good balance sheet, a normalized PE of about 17 times, which remains above the historical median of 12 and a half times. And risks include continued labor interruptions, potential commodity risk, and operational risk with expanding their potash operations. So the company is expecting to have a good fiscal year with easy comparables to fiscal year 2022 because of the labor strike, which brought down revenue and EPS in Q4 and Q3 of 2022. But overall, for the dividend, I think that the stock is reasonable and most likely why Jim Pattison has been buying it. But for the lack of growth, exposure to coal and commodities, potential labor disruptions, and a valuation that remains above its historical median, it is not a business which we would recommend. And that's it. That's
Right.
all.
Yeah. I mean, it is a nice dividend there, 4.5%. And then I
Yeah.
did note, I took a look at the growth over the last couple of years, and they have been moving that dividend up. Although based, relative to taking into account the historical earnings, I'm imagine that the payout ratio has been moving up as well.
Mhm.
Yeah, I'm seeing a trailing 12-month payout ratio of 110%. So
Yeah.
yeah, so I mean, one thing I will note is that I did just do a little research on the side there, and they primarily ship metallurgical coal, which is used in steel making. They do some thermal coal, which is used in electricity production. But in the context of phasing out coal, that's typically, from my understanding, thermal coal,
Yeah. That
whereas
makes sense.
metallurgical coal is still a required ingredient in the steelmaking process. So it's interesting. I mean, one of the things that I've always thought in the past is that it doesn't have that growth outlook that I want. Like, obviously there's some cyclicality in the business. Revenues and earnings have moved up and down. It's always had a nice yield, but you want to see like some type of capacity expansion or acquisition opportunity, some way to generate sustainable growth over time. Maybe this expansion into potash is a way to do it. But of course, we're going to have to wait till 2026 to find out.
Yeah, exactly. And like I was reading further just on, Jim Pattison's um, company basically, or Great Pacific Capital, investing. And, they've been a shareholder for a very long time, from my understanding. And I was reading articles where they were saying that he actually has, from where he's been purchasing the stock over, all the years, he has like a weighted or an effective yield, a weighted average effective yield of about 10%. So,
Mm-hmm.
on that capital that he's investing, he's making a great yield,
Mm-hmm.
without the growth in the business. So again, I think that that's probably primarily why they are investing. I don't know for sure, obviously, but that would be my assumption.
Mm-hmm.